I first started investing, it was definitely a founder's market. Valuations for companies doing 100K was $10 million, and investors didn't really have a choice but to accept that because that's what other investors were doing. Valuations have come down significantly, which can be difficult as a founder, but you have to really think about it in the way that you're being more realistic about your potential growth in the company. Do what you're going to do, perform the way that you're expected to perform, and then try and go for that higher price. But if you go for that higher price on the jump, you're most likely going to end up having a down round because things don't always go as planned, and you want to just be realistic. And it shows your investors too that you're not overvaluing yourself, you're not undervaluing yourself, you're just making sure that you get what's going on and you're being efficient with the way that you're managing your capital and what you're expecting and your expectations. And from an investor too, we don't need to see $1 billion exits, which we are now seeing, but we don't need to see that. It can be $100 million and still be meaningful for all parties.
Shake your money maker. Well, today we're shaking it up with a bunch of money makers. We've got 4 of the most active food investors. These are VCs actively writing checks for early stage CPGs, and they are here today talking to you about how do they find brands, what are the kind of brands and trends that they're most interested in right now, what kind of advice do they have about fundraising and valuations for early stage brands, and so much more. I want to thank our panelists today. It's Greer Tessler from Simple Food Ventures, Daniel Faierman from Habitat Partners, Carolyn Simmons from Melitas Ventures, and Andrew Reynolds from RCV Frontline on a truly epic discussion. And at the end, we even had time for some brand pitches. Listen, and I think you're going to love this one. Hello, everybody. I'm Daniel. I'm the founder of Startup CPG. Welcome. And if you're watching us on YouTube, make sure you hit the subscribe button. I am very excited about this particular panel. I had asked Ryan Williams from Fabid in a previous discussion, hey, who are really the VCs that are the most active right now? Because they're the ones I want the community to meet. I feel like I go to a lot of events and they're quote unquote VCs who are there, but it doesn't really seem like they invest that much, but they'll give you a lot of advice. I'm like, no, who are the ones that are writing checks these days? These are the ones where we really need to focus attention and learn from them and what they're looking at and give the brands a chance to get to know them. So these are they. Thank you guys so much for making yourselves accessible to our wonderful community of brands. And so we have a bunch of questions here, but just to get started, I wonder if I could go to each of you and just ask you to start off by first introducing yourself and what you do. So I'm going to start with Andrew, and then I'll go Greer and Carolyn. So that's the order on my screen.
Sounds good. Startup CPG Universe. Hello, my name is Andrew Reynolds. I am a partner with RCV Frontline. Me and my partner, Jeff Grogg, started the fund in 2020 to bring some operational support to the early stage companies we invest in. Early stage to us are companies in the 1 to 10 million revenue run rate range. We have about 17 companies in our portfolio based in New York and Battle Creek, actively investing. And, that's it. Looking forward to answering some questions and hopefully making fundraising that much more easier in this challenging environment.
All right. And Andrew, maybe a couple brands that you guys have invested in recently or that are in your portfolio?
Yeah, absolutely. We were actively investing. The most recent brand we invested in was a company out of New York called Hypnotic on the earlier stage. Going through the portfolio, mentioned just a few highlights: Rind, Lemon Perfect, Muddy Bites. I'm going to be forgetting a lot here on the spot. Bonafide Provisions, Hoplark, to name a few. We have a few others in there, obviously.
All right. I love Hypnotic. That's a great call. Good job, Frontline. All right. Okay. So I'm going to come to Greer next.
Hi, everybody. I'm Greer Tessler. I am founding partner of Simple Food Ventures, also founded in June of 2020. Thought it'd be a good activity to do in COVID. So we are an early stage CPG fund. We invest in everything from pre-revenue to Series A, Series B. And our special sauce is really helping brands enter and scale through conventional grocery. I have a relationship with Albertsons, and so we help brands enter and scale through Albertsons and really bring them into our diligence process. So kind of thinking of us as like the conventional retail experts in the way that we invest with our companies. And we look for products that are creating cleaner, better for you versions of grocery staples, because obviously shoppers don't really want to change their consumer behavior, but they want the opportunity to be able to actually eat products that are better for their body and don't have such toxic ingredients in them. So that's what we do. Our investments range anywhere from Bashans, the Japanese barbecue sauce, to Baliwelli, Crave Jerky, Ouroboros. As of yesterday, and co-investor with Daniel on this one, AO, which is a flavored mayo brand that is founded by Molly Baz. We were founding investors in that, which everybody should go try it. It launched yesterday. It's amazing. Cure Hydration. So just to name a few.
I love it. And I'm enjoying myself an Ouroboros grapefruit elderflower right now, and I highly recommend it. Okay, great. Thanks, Greer. Carolyn, I'm going to come to you next.
Hi, everyone. My name is Carolyn Simmons. I'm a partner at Melitas Ventures. I joined about 2.5, 3.
You got the freeze. Frozen for everybody, right?
Yeah.
Okay, cool. All right, we will come back to Carolyn. The suspense is going to kill me. All right. What was she going to say? Okay, Daniel, do you mind? We're just doing a round of intros. If you mind introducing yourself and your firm.
Yeah, thanks for having me. I'm Daniel Faierman. I'm a partner over at Habitat Partners. Similar to Greer, we invest pre-seed to Series A, mostly pre-seed and seed. We have invested in now, I want to say, about 14 consumer brands. Some of our portfolio companies include Mez Club most recently, and AO, as Greer mentioned. Also invested in Muddy Bites. One of our portfolios, Happy Wolf Snacks, just launched in Whole Foods last week, so we're excited about that. And yeah, our angle, if Greer's kind of angle is more of the sales kind of side, I'd say our angle is more of the marketing side. We were born out of a creative agency called Red Antler. Red Antler was doing some balance sheet investing from around 2017 to 2020. Had a lot of success with that strategy, and ultimately we spun out Habitat Partners as an independent entity that we operate independently.
All right. Red Antler, for people who don't know it, I think is the firm that everyone would be like, if you have all the money in the world and want the best design possible, you would go to them.
Well, portfolio companies are treated a little especially on the price side, so not always.
Right.
Yes. Yeah.
Not an arm and a leg, just an arm. All right.
That's right.
All right. Great. Carolyn, all right, I'm coming back to you.
Thank you. Sorry I cut out there. I was just saying I joined Melitas Ventures about 3 years ago as a partner at the fund, founded originally in 2018 as a $19 million fund. And today we're just now closing on Fund 3, which will be larger than our Fund 2, which was $60 million. So we are actively deploying and excited about partnering with better for you consumer brands, specifically in consumer products. So at our core is better for you food and beverage. And within our portfolio, you'll see we have brands ranging from Olipop to Magic Spoon, Lemon Perfect, Rind. Andrew, we have some overlap.
For sure.
Our most recent investment was in Evergreen, which is a better for you frozen waffle brand, and we often lead those investments. So taking really active roles in everything from more strategic to like branding and marketing, to assisting brands in financing processes, to you name it. So we're based here in New York, and I'm on a team with 3 other general partners.
All right, fantastic. So jumping right into it, I'm going to go through the same order with you all, if that's okay. What are you seeing in the current fundraising environment? Advice to brands, like valuations you think early brands could be asking for? Overall tips here. Andrew.
Yeah, I think as we all kind of experience in some form, it's a really difficult funding market for sure. What we've seen, kind of giving a shout out to Ryan and the FadBit team, he put out his Q3 report a couple of weeks ago, and kind of deal volume has been pretty flat through the year with roughly kind of 50 or 52 deals per quarter. The good news in Q3 was the amount of dollars that came in were up. I think he had around 340 million or so into food and beverage. The frustrating news is around 60% of that went to more mature companies in that kind of scale of the emerging brands. So the early stage is still really difficult to get funding. What we're seeing in terms of kind of deal terms, not a lot of prices. Excuse me for 1 second. Amelia, I'm on a call, sweetie. You gotta talk right now. Sorry about that, guys. My coworkers here. So we're seeing, not a lot of price rounds early on. Everyone's using, or a lot are using safes and convertible notes. I think the caps and the valuations on those have come down to kind of more realistic numbers or appropriate numbers in past years. But the valuations, if we're seeing a price round, has typically been kind of extensions of previous rounds that they're kind of pulling forward. So that's part of it. And everything's taking longer. The rounds, people have been fundraising for so long, and we're seeing a lot of the same deals, talking to the other funds that we love to work with and discussing deals and trying to get something done for some of the companies.
Amazing. Okay. Greer?
Yeah, I mean, I totally agree with him. I think that in terms of advice, I mean, we're definitely seeing, when I first started investing, it was definitely a founder's market. Valuations for companies doing 100K was $10 million, and investors didn't really have a choice but to accept that because that's what other investors were doing at the time. Valuations have come down significantly, which can be difficult as a founder, but you have to really think about it in the way that you're being more realistic about your potential growth in the company. So also if you value yourself at a 1 to 2x revenue multiple this time around, it gives you time to get cash in, which is incredibly important and incredibly difficult. Do what you're going to do, perform the way that you're expected to perform, and then try and go for that higher price. But if you go for that higher price on the jump, you're most likely going to end up having a down round because things don't always go as planned, and you want to just be realistic. And it shows your investors too that you're not overvaluing yourself, you're not undervaluing yourself, you're just making sure that you get what's going on, and you're being efficient with the way that you're managing your capital and what you're expecting and your expectations. And from an investor too, we don't if valuations are so low, the bright side is we don't need to see $1 billion exits, which we are now seeing, but we don't need to see that. It can be $100 million and still be meaningful for all parties. And so that's kind of an exciting almost moment in consumer, I think, that's going to really reinvigorate things again.
Great. Thank you, Greer. Daniel, coming to you.
Yeah, I think both of you guys nailed it. I think to put a few more specific number ranges on the valuation side, so we talk specifics, I think on the pre-seed side for food and beverage, we're seeing a range of about 3 to 7 post, 5 being the most common benchmark for an appropriate valuation if we feel the concept is pretty strong alongside the founding team. I think with seed, it's been anywhere from 7 to 14. Sometimes it depends on if it's more of a later seed or an early seed. And then A's being done really anywhere between 15 all the way up to 30, again, depending on kind of the range of the business. I think what's kind of interesting right now is just I think to Andrew's point, the bar for pre-seed has just never been higher in terms of concept differentiation as the core factor. I think using AO as an example for Greer and I, it's an example of a product that we really felt was innovative and disruptive to the mayo category and really hadn't been kind of done before. And so I think just in terms of founders who are starting businesses in the pre-seed phase, being able to really answer strongly to a core differentiation point, is essential. And then I think given that there isn't a ton of data to go off of in the pre-seed phase, and because profitability has become even more important earlier, gross margins alongside founding team is that second variable that even in the pre-seed phase, we diligence quite closely. We'll ask for co-man contracts as a means of auditing the cost inputs of actually doing a production run compared to the price that you'll be selling to a retailer distributor. So those are some of the main things that I'm thinking about these days with really early stage deals. And then, yeah, I think to Greer's point, what's exciting is it feels to me valuations are kind of feeling a bit more like aligned to reality and realistic, kind of like expectation wise. And so that for me is making my life a lot busier, because when I used to be able to say no to a lot of stuff by just scanning valuation, I can't do that as often anymore. And so there's a lot of stuff coming across my desk with real pricing expectations that make me want to dig in further.
Great. Thanks so much for those numbers, Daniel. Carolyn, coming to you.
Just to elaborate, I guess, on what Daniel very well articulated, I would just add, in terms of pre-seed, really pre-seed and kind of these early seed deals, a lot of the valuation you may be asking is, what is that based on, when you don't have any real data to be looking at? So what we as investors are really digging into is first that differentiation piece. So really leaning into and clearly articulating how your product or service is quite unique relative to the closest direct competitors that you have in the space is one key component that we look at. Another one would be the market potential based on that. And then on the financial piece, Daniel, you really hit the nail on the head there. We're really also leaning into margins and profitability, and if not current profitability, it's path to profitability. And where we see trades at a premium or the higher end of the range is are businesses that are either clearly on track to achieve a relatively high margin in the category. So, as I mentioned, frozen is a space we recently invested in. That trade happened at a premium for frozen, which is typically 2 to 3 times because of the strength of those margins. And so that's something that we really look at. And then finally, I would add, we really look to see founder experience and or grit and resilience and potential generally, your vision for the brand and how you plan to grow and ultimately exit it and what that exit potential looks like. And I know that feels a little murky, all of those different factors combined, but in terms of your second question, Daniel, on just advice to give founders, I mentioned those things because every one of the investors that you talk to will be evaluating at least a few of those things. And so the more practice and clear articulation you have of those key points will ultimately, I think, serve you well in communicating real value.
Thank you, Carolyn. I wonder if Carolyn or any of you want to give guidance on margins that people should be able to get to, whether it's in the early stage, don't worry about as much, or when you get to X amount in revenue, here's where we kind of want to see you. Any color that you guys can provide or examples?
I think for us, looking at the early stage, which I think most of the audience on this call is, we are not expecting those companies to be profitable yet. So we want to see while they're unfavorable at that time, a very clear bridge to how you're going to improve that margin. If it's just a simple answer, volume's going to go up and we're going to have better margins, it doesn't usually work that straight. So really understanding, I think Daniel mentioned it, your co-man contracts, are there price breaks baked in, are there buying bulk? Some of those items, and really understanding what those breakpoints are, where you're going to have more room to play, and kind of what your targets are, which should then come back and inform how much you're raising, what those milestones are that you're using the capital that you're bringing in for those rounds. I think the margin varies by category, kind of what you want to see early on. For us, if it's starting out and it's negative gross margin, we simply will probably say, love what you're doing, but let's connect in a year and see how you are. So minimum for us, I think we want to see something, certainly north of 15%.
Yeah.
At the very, very least.
Yeah, I totally agree with Andrew. And I think that it is very category specific. I mean, some categories you can actually really do D2C, easier to ship, different, better margins than maybe necessarily in retail. So it'll just really depend. When we're looking at it though, for a pre-revenue company, obviously you're not profitable from the beginning unless, I don't know, some companies can manage that, but you're not profitable from the jump, but it's just a clear path to how you're going to get there. And then understanding too, what you're spending on OpEx in the beginning and why, and being able to justify those numbers too. So do you need a COO, probably because it's one of the more important roles in getting a business off the ground and just going. But maybe you don't need a CMO, or and looking at like where you can cut costs, that can affect that margin as well.
I would just really quickly add, because we're throwing around lots of margin numbers and there are so many different margins, and I'm seeing some questions in the chat right now, like, what is this margin? So there's gross margin, there's contribution margin, and then there's obviously EBITDA margin, and then net margin, net income margin. So investors, at least I can speak from our perspective, we look at the all-in contribution margin. So net of freight, logistics, and other product-related costs. I often read decks and see numbers presented as gross margin. We consider all product-related costs in that number, and we use that too to evaluate things like customer lifetime value, because that to us is a clean, true number of what your income is net of all product-related costs.
Yeah,
and
you
I saw
nailed it,
Tal
Carolyn.
had that. Oh, sorry, Daniel. I was just going to say, I saw Tal, someone had a question on there referencing the 15%. I said, I was talking about gross margin, but something at 15 would not get us excited. I'm just saying a kind of a bare minimum of something that, we keep reading. So I just wanted to clarify that.
I mean, the golden number for me has always been 35. That, at least for us, like, if it's not above 35 in this environment, we've been unlikely to move forward. I mean, maybe that's like a pretty high bar, and I'm sure I probably get stuff wrong by not looking at those deals, but like taking in, freight out warehouse and fulfillment, like we want to see that at least 35, which I know is high. And that's also kept us away from certain categories like beverage in the past year, knowing that's like almost impossible to do in the early days. But like in the condiment section, that's actually like feasible to do in the very early days, which I think is like part of the reason why we're attracted to that space right now. And I think from our perspective, like part of the reason why we're so obsessed with this metric is because the companies that are able to drop more dollars to the gross profit line essentially need less capital over time. And if a business needs less capital over time, our entry point is going to be less diluted over time, which means that if there is an exit, it's going to be a stronger return for us in the long term.
Maybe just one follow up on that one, Daniel, which is, okay, if I think about beverage versus like condiments, like mayo. So yeah, beverage, higher cost, of course, a lot higher velocity though on the store. Also, if you compare something like condiments, which would be like, lower price point, lower velocity. Do you take that into account when you're thinking about that kind of an opportunity?
Yeah, I mean, honestly, not really, because part of my thesis surrounding like innovation in condiments is that it can accelerate like the historical velocity trend that has normally been seen on shelf in that category. I think what I'm more thinking about is like, and I think, Carolyn is an Olipop investor at Melitas as an example. Like if you compare the soda category to the mayo category, the condiment category, like soda is such a massive, massive TAM that like, even if it requires more capital along the way, you probably feel comfortable underwriting to like a $500 to $700 million exit if it goes well. Whereas like in condiments, if I look at the exit size from like historical M&A and also just think of the size of the category, I'm probably only underwriting to like a $200 to like $350 million exit. So I guess I think more about like size of exit potential based off the category as opposed to comparing like velocities on shelf.
Awesome. Okay, thank you. Next question for you all is, what products or trends are you most interested in right now? AKA like any areas of your portfolio you're really looking to build out, or if there's a brand out there that has this particular thing, they should reach out to you. Andrew, coming back to you.
Yeah, we've looked at some of the kind of a common theme is a low sugar and clean ingredient. It's all over the place, but I think it is a powerful one that there are more brands in many different categories that can still benefit from a better product with a simple formula like that. So broadly speaking, that's one. Two, I'm certainly learning more about kind of the change in opinions on seed oils and how does that play out to the consumer, and what's an angle that's going to resonate with. In terms of specific brands, this is the perfect thing we're looking for. No, looking at a lot of things, sugar reduction has been popular. We've started looking at salt reduction too, and some of that technology more on the food tech side. but we're still kind of open and looking at all categories and all brands that really have that combination of that founder, that perfect brand, and a delicious product.
Low sugar, are you looking for lightly sweetened? Are you looking for sugar replacements? Do you have a view on which sweeteners you're okay with, which ones you don't like right now?
We do. We certainly firm-wide have kind of opinions on that. I think consumer-wise, a lot of the sugar alcohols are kind of frowned upon, whether that's appropriate or not. But I think looking at, we want to see the cleaner it can be and kind of the easier to translate to the consumer that this is sugar or something very similar, the better.
All right. Thanks. Greer,
And a
coming
lot
to
of
you.
products need sugar. So we're now looking for no sugar in a lot of cases.
All right. Great. Thank you. Greer.
So, people always ask this question, and it's a little bit, I feel like it's just a tricky question to answer, because you'll see like at one time there's like 10 popcorn brands that you're going to see within 2 months. And then there's going to be multiple pet food brands. And so it kind of, all of the trends sort of just come in chunks. We're very interested in the baby food space right now. We see a lot of opportunity there. We think that, as consumers are just more aware of what products on the market do to our bodies, and especially like moms are aware of this, they're going to not really trust these mass brands to provide baby food options for their kids. And so you see, Sarah Belly, Serenity Kids really kind of like stepping up and taking over market share. So that space, we see a lot of opportunity. We see a lot of opportunity, and we're interested in pet, frozen pet specifically. I think that it's still pretty nascent within retail in terms of fresh frozen pet. And, like Farmer's Dog Control is 2 to 3% of the market share of the dog food space, which in my mind is small. And so I think that there's just a lot of opportunity within that market. We are actually at the tail end of our first fund and starting to invest in our second fund. So we have the opportunity to actually go wide and not worry about being competitive with any of our existing portfolio investments. So we're really open to just categories. So if you guys have great brands out there, definitely reach out. Anything that is clean ingredient. We look for companies with large addressable markets, accessible ingredients, high velocities, great margin profiles, and founders who, like Carolyn was talking about, have the operational experience, or if they don't, they seek it out, but are really like willing to understand the mechanics that their brands need to do to be successful.
All right, Daniel.
Yeah, I probably am going to take one of Caroline's. So Greer talked about baby nutrition. We think that baby nutrition is a little bit more crowded than like kids nutrition. And so we've been really focused on the age group, I would say between like 4 to 12. I think with baby, it's an incredibly strong category, but I feel like there's just so many that have emerged, and I feel like there's kind of less that have scaled in that 4 to 12 age group category. So we're super focused on that space. We've already invested in 2 businesses, one called Happy Wolf Snacks and another one called Roxberry. That's a kid's beverage. I mean, I'll leave it at that and kind of give the floor to Caroline, but that is the space that I'm spending a lot of my time on right now. And it's more of a portfolio management focus, but just generally is something we've been super bullish on. As you can see, I have a little baby picture in the background. So I'm a new dad. So I've just been very focused on it, as I think Caroline's a newer parent also. And so another area that like we've also invested again, and I don't think this is going to be surprising to anyone, is just like proteinification across the grocery store. There's a million different ways in which that's manifesting itself. We invested recently in a protein bar brand called Mess Club, but I think the overlap of protein in desserts is interesting. We think the overlap of protein and kind of the carbohydrate section, whether that's bread or pasta, is still interesting as well. So we're constantly kind of learning from consumers how they're using protein and kind of desiring it in unique manners.
Okay, great. Coming to you, Carolyn.
Great. I would second both of those. And we recently invested in Evergreen, which I mentioned on the toddler kid side. And then also Amara, which is well known for its organic toddler melts. Both exceptional businesses and both catering to millennial parents looking to provide healthier alternatives for their children and toddlers. I would add ones that have been on our radar for a while are global ethnic foods that are authentic and clean label and maybe internationally inspired, but still approachable to the American consumer. High protein, and we can see this as Daniel mentioned, really with the rise of GLP-1, there's really a need for holistic, high protein, but nutritionally holistic alternatives to those that are no longer getting the nutrients that they need and no longer have necessarily as much appetite. On the other side of that, I've also seen a lot of innovation in the kind of indulgent space. So I'm seeing, a real push towards maybe it's more indulgent, i.e., high fat or high sugar, but novel experiences. So we're looking at some in the frozen novelties space and other shelf-stable treats, but in some way are kind of cleaner or better for you. Maybe they are date sugar powered, for example. So those are a few that we're looking at.
All right. Amazing comments. Thank you. So, you guys are some of the top VCs out there, but what would you actually recommend to an early brand or yourself if you didn't have all the connections that you have about how to go about growing your business and raising money? Would you say like, hey, side hustle it as long as you can, bootstrap, maybe go to an angel investor because they're going to give you a better valuation than I will? Or would you say, no, like we're the right people, try to get us as early as possible because of the help that we're going to give you steering your business? Real talk here. All right, Andrew, coming to you first.
We'll be right back. Hola, amigos. About 4 years ago, I got a message from a designer in Colombia who said she'd like to work with Startup CPG to build her reputation in the US. I couldn't believe how affordable her pricing was, and the quality looked top-notch. I started work with them for Startup CPG and then a bunch of my other CPG projects as well. Fast forward to today, they are the most beloved agency in our Startup CPG community. They've got dozens of happy customers like Prickly and so many more. I recommend them to absolutely anybody who will listen because the combo of top-notch quality and very reasonable pricing is exactly what you want as a startup brand. You can hire them for branding, packaging, your website, or they actually have an awesome startup package that will do all three. If you want to learn more, email them at startupcpg@wagondesignstudio.com or check the show notes. You could also post in our Slack for feedback and just be overwhelmed by how many people want to sing their praises. Gracias, Wagon! And now, back to the show.
I would hold off on the funds until you're a little bit more mature would be some advice. However, that said, you have two panelists here who invest in pre-seed. So it's a different perspective than I have. I think if you can bootstrap and the longer you can go without taking on any kind of institutional dollars, the better. Angels, they're out there. We just went through an exercise looking at kind of 30 funds and how many different companies they invested. Angels are a huge part of this community in funding the early stage. So I think they're out there. They are hard as hell to find, but there are more resources now than ever to find it with Startup CPG and others where they have great databases that you can kind of check into and kind of at least have a starting point. So I think the longer you can avoid raising outside funds, the better. But yes, if you can lean and stretch those friends and family dollars, do it. What would be my short advice?
All right, Greer, anything to add?
Yeah, I mean, I guess so. We have made a couple of pre-revenue investments. There's been specific reasons why we did it, whether it was the founder and the concept, and we kind of sort of incubated a few of them. If that's not the case, and you're pre-revenue or you're doing 50 to 100K in revenue, don't go to funds yet because you're not going to get a good response for them at that time. Like, go to angels, go to I always say too, like crowdsourcing, like Republic or GoFunder are great ways where you can get your customers to be your advocates and to be your investors so that they have some skin in the game. I think that like those ways to really kind of show your proof points And then your next round, once you've actually really kind of proven yourself out, go to those funds and start to have those conversations. Also, don't price yourself too early, because you can get in a situation where it's not the price that you wanted, and then you get incredibly diluted as you continue to raise money. So,
all right, Daniel.
Yeah, I mean, I agree with Greer in a lot of cases. Like, if you can get, obviously, and Andrew, if you can get some material traction under the belt before you got to investors, I think that's ideal. I don't think there's anything wrong with starting relationships early on, especially when you're not raising. Like, I love, founders reaching out, not looking for money, but wanting just like feedback on a concept before they go out to actually like raise from me is something that I think is like a healthy exercise and a way to like get my attention early. And it's kind of nice because I'm not meeting the founder in the context of like their raise for the first time, which is like a more comfortable way to obviously meet someone generally. I think another thing to like do is, founders want to help founders, of course. And so if you look at the founders in each of our portfolios, and if there's some way to like get their feedback and attention as well, that's also a really good avenue to us, because our founders often like want to, send us companies that they find interesting and support of other founders. So I think like, obviously you can try to reach out directly to funds, but I think one of the best ways to really get in front of a VC if you're having like trouble with just like cold outreach is to go through the founder community who's connected to investors and has already raised from them, because investors obviously have pretty tight relationships with their founders and kind of trust their inbound.
Okay, great. Carolyn.
That's a great point, Daniel. I would just add one other thing. I would say the amount and timing of a raise can also just depend on the category dynamics. So I wouldn't say necessarily that it's best to push off a larger fundraise as long as you can and raise from angels and crowdfunding. If it's a really highly competitive category where stepping on the gas by putting a lot into marketing because that marketing is generating high retention customers, then you should go for it and you should raise. And as Daniel mentioned, starting those conversations early is important. But we've invested in some more highly competitive categories where I would say it's a race to the finish line, and a lot of that growth is going to be based on who gets there first, and there's a first mover's advantage. And in those cases, you don't necessarily want to wait and try to self-fund as long as possible, right? That's the benefit of VC. And I'm not necessarily selling VC, but I'm just saying there are situations where you do want to raise, and you want to raise quicker than your nearest competitor.
All right. Great responses here, guys. I hope everyone appreciates how awesome this panel is. Like this, it's hard, you'd be hard pressed to find just such an active group of thoughtful investors out here. And I'm seeing it in the comments. And so thank you guys again. This is just really energizing to hear from all of you. Okay, next one. So for brands that are pitching you, what tips do you have for them to get on your radar and to send you a good message that you're going to, smile and be intrigued at rather than being turned off by? Andrew?
Yeah, I think two things. One, in person, you touched on energy. Energy comes across so importantly in a conversation, whether that's at a cocktail thing or a meetup. So kind of bringing the energy, how excited you are around your brand is one thing. Coming into decks, kind of for early stage, again, companies, I certainly want to focus on kind of the go-to-market strategy. How are you expecting to grow your business? Is it multiple channels? Is it one anchor retailer? Like really have that thought through and understand, the trade-offs and costs of going through those different channels. I think at the end of the day, you have to be where your consumer is. So understanding where they're shopping, as much homework as you can have and demonstrate early on is very helpful. And of course, like the old adage, know your numbers, know your COGS, know exactly what's going into your product. You touched on it before in terms of how you're going to grow your margin, what those important breaks are and how you're going to improve your business is huge. And then team members, there's a big world of service providers out there. Do you know who you need? Are you planning on building your team internally? Just having good answers in terms of to demonstrate that you've thought out how this is going to grow. To Caroline's point, if they're raising a lot of money early on, you want them to be experienced and to demonstrate that they know how those dollars are going to be used and what results they're going to get out of them.
Great answer. Thank you. Okay, Greer.
I think that Andrew nailed it. I think also it's important, like, come with passion. Like, if you're a founder for a business, why'd you found it? I mean, I personally like drink the Kool-Aid very quickly. Like, I love falling in love with a founder and their story and like their passion for their company, because if you can sell to me, you can sell to your customer. And so that's a big part of it. Just like more of a, high level look at it. Knowing too who you're pitching to. So like why Simple Food Ventures makes sense as an investor for you. We really like to be more than just a check. So want to understand, if you kind of like fit into who we are and like what makes sense from that standpoint, know your numbers for sure. And understand like why you're the right person to run the business. And if you are, where your weaknesses are, but also like what you're going to do to kind of like counteract those. So thinking about questions that I might ask before I ask them.
All right. I love it. And hopefully everyone here has the passion. Okay, Daniel.
Yeah, I mean, I think there's so many good points that have already been said. I think I talked a little bit about like one of the best ways to get to investors in the first place is through another third party that like the investor trusts, as opposed to like cold outreaching, which like a great cold outreach email can work, but we're getting so many kind of inbounds all the time. If there's like one trust layer that can like be put in front of us, that like, that can obviously increase the conversion rate of us responding and kind of seeing it, to be completely honest. I think in terms of like the pitch, like two completely random thoughts that just popped into my head. So like one is being short and punchy. If it takes like 25 slides to explain what you're doing, then like I feel like it's probably going to be complex to explain to the consumer like why like your proposition will like resonate. So I think a big thing is keeping these short and punchy, trying to obviously tell the story about your mandate and what you're selling, but then also following it with just quick punchy data that's quantitative and objective. And then the other thing I'll say is like I've had experiences with founders where they will kind of exaggerate certain accomplishments and stats in the early days. And like we do our homework very, very like closely on any kind of number or any kind of velocity or any kind of like figures that are put in front of us. And so if someone is kind of like, hey, like we're getting into all these national retailers next year and we're going to be in like thousands and thousands of doors, but then we find out that it's like one region of like, then we know that like there's this like exaggeration push that's happening. And when that happens, it makes me feel like I might not be able to trust the founder like long term. So I guess just like integrity at the forefront of like anything you put in front of investors is really important, because like I will personally check any statement that like could make your integrity questionable.
Okay, Carolyn.
These are all great points. I would add on how to get an investor's attention. You would be surprised how many pitch decks I see that actually don't clearly articulate what problem they're solving and what the product is and how it's different. Because we all invest in food and beverage brands, we see hundreds and hundreds of food and beverage brands a year. All of us do. And so when you take a category like the bar category, for example, I really want to understand very simply, punchy, as Daniel said, how is this different? What problem is this solving? Why is this going to succeed in a very competitive market? I think if you start with that and the problem you're solving, you'll go a long way. And that would be really my biggest piece of advice.
And just to follow up a little bit more on one of the points Daniel and I think a few other people touched on this about getting people to kind of recommend you. What I've heard from VCs is it's kind of a way to have your network do a little bit of the vetting for you, which is nice. Like if a founder that you respect, it takes time out of their day and a little bit of reputational risk to actually send you a note about another founder, you're probably going to listen closely, right? So for anyone who's probably sending out a lot of pitches and not getting much back, that might be a good way to invest some of your energy, is well, let me look at their website and see all their portfolio companies. Do I know any of them? Could I sell some of those founders on my product the same way I might a VC to get them to champion me with some of their connections? So that could be a good point for everybody.
Actually, Daniel, on that really quick, in addition to us doing our diligence on you, you should also do your diligence on us. So you should really ask your founder friends. Don't just rely on our references that we give you. Get a sense of what it's like to work with a fund like Melitas or any of these other amazing funds here on the panel. That's really important too, because ultimately, it's a partnership and we're in it for the long haul. So you really want to make sure you have a good relationship.
Yeah. And Daniel, when I found out about Machu Picchu, it was through Midday Squares. So that's just an example. Like, I'm close to them because I angel invested and then they told me about what you were doing on the T side. So it just shows like going through other founders can be like a great avenue.
Yeah. Yeah. That makes a lot of sense. That's very nice of those guys. They're
And I think
good folk.
I think Carolyn and Greer just went through this, and we've gone on the same side of fundraising. And no is unfortunately a huge part of the game. We say no way more than we say yes, and it's really frustrating. But I think keeping that in mind, and also execution is one of the best sales tools that I see. If I meet someone, we say no, and a year later they do everything they said they were going to do. That speaks volumes. And we've had situations where we have come back and invested. It just wasn't the right time for a few reasons. So start that relationship early, get investors on your email update list every quarter is a great way to kind of softly build that relationship and trust.
I also think there's two things. If there is a no, ask why. Because sometimes it's, looking at the constructive criticism or just the reason why might help you along the way. And then also ask the investors if they know anyone else that might be more appropriate for the company.
Awesome. And Carolyn, I just want to ask you specifically, since you mentioned this, if you're talking to one of your friends who's a founder and you're like, oh, you're talking to VCs, well, you should watch out for this. Like, is there something something specific they should screen on? Like maybe don't partner with a VC that does this or that doesn't ask you about this, or, from their reputation is like this. Any major red flags?
I think it would really just be understanding exactly what the expectations are and how that particular VC likes to work. Like, what is the cadence of communication like? What is the amount of reporting that is required? Is that VC mostly going to be outreaching to you and asking for things, or are you the one, or is the onus on you to reach out and provide information and ask questions? I would just ask more specifically, like, what is the cadence? What does that VC like to work with?
I love it. Guys, thank you. Thank you so much. These questions are incredible. And I would be doing a disservice to everybody if, when I had one of the greatest panels of active VC investors out there, we didn't get at least a couple brands up here to do a couple quick pitches so we can all learn from it. So for anyone out there, I'm going to ask one more question in a second, but if you want to jump on stage real quick and do literally a 15-second pitch about your brand, and then at the end, we'll probably get a little bit of feedback from these all-stars, you can raise your hand. I'll invite you up. Make sure you're muted when I do that, and then I'll call you when it's time to do your pitch. And this is just for CPG brands, like you make a product that's like, a drink or a beauty product or food. So just for that. But just last question while we're getting some hands up here, which is, if people want to not just try to pitch you on LinkedIn or email, but actually like maybe come across you and do that elevator pitch, in like, what's a good way for people to follow up with you? Is it on LinkedIn or, through your website? And secondly, just real quick, what shows will you be at in the next 6 to 12 months? Andrew?
Happy to put my email out there. People can contact directly. In terms of shows, I do not like LinkedIn. It's a kind of a pain in the butt, so direct is better. In terms of shows, naturally, was it Expo West? I'll probably be out at Utopia again. The Naturally New York events I'm at pretty frequently, and Startup CPG more so in New York now. So those are some of the big ones.
All right, you said the magic word, Startup CPG. Greer.
Yeah, you guys can email me directly. I think that LinkedIn, just things get lost. There's a lot of like junk in mails that come through LinkedIn. So my email is just my name @simplefoodventures.com. and shows definitely Expo West. I'm not really sure what else necessarily. We're kind of in the midst of a fundraise, so we've been really focused on that. But I'm sure I'll see some startup events and some Naturally New York events as well.
All right, perfect. Daniel.
Yeah, direct email is best. I am often slow to respond because it's just me and one other person. But I'm also very active on LinkedIn. So like if you want to hear more about like the way I'm thinking about the landscape, definitely throw me a follower connection. In terms of events, I'll definitely be at Expo. I might be at an upcoming BevNet event, still deciding. However, yeah, I'll see you in LA if you'll be there.
We'll be right back. Hello, everybody. I am so excited to announce that Startup CPG finally has an official Amazon agency partner. I know a lot of you are looking to Amazon as a great growth channel for this year and beyond, and Daybreak is the best agency that I've come across that will work with emerging brands. They have a really affordable retainer structure. It's a lot less than you'll find with other agencies that might charge you upwards of $5,000 a month, which is crazy. Based on recommendations from this community, I actually worked with Leon for my own brand and had an amazing experience. The sales grew very quickly. We started ranking really high on organic search results and really just capturing search terms in the category. I think he is an amazing fit for brands in this community, and I highly recommend reaching out to him for a chat. You can reach out to him at leon@daybreak.agency. That's LEON at Daybreak, DAYBREAK.agency. Make sure you mention us at Startup CPG so that you can get $600 of free design credits if you end up working with them. Good luck. And now, back to the show.
All right. And anyone going to BevNet, we have our Startup CPG holiday party in LA, December 9th, karaoke party hosted by yours truly. So make sure you all sign up for that. Carolyn?
Someone from the Melitas team will be at all of the events mentioned. So please join and feel free to say hi to any one of us. My email is great. I'm also on LinkedIn. It's Carolyn@melitasventures.com. I think that was it.
All right, now let's hear from some brands who are ready to pitch to this incredible panel. Perfect. So if you guys are ready for some quick pitches, just quick tip for everybody. If you want to, it's great if you also want to show your product. If you have like a background screen on, it doesn't show if you do this, but if you hold it in front of you, it always does. Just pro tip for everybody, hold it in front of you. Okay, cool. Nicole, I'm going to come to you first because I can see your product up. So literally, 15-second pitches, guys. And then I'm just going to try to cycle through. And then hopefully our panelists can just give some general feedback at the end and call out anything that they thought was super cool. So Nicole Gordon, go for it.
Hi, so I developed Nikigo Original Sauce, which is a soy-free alternative to soy sauce made with just 3 ingredients, mushroom, salt, and water. We beat coconut aminos 9 out of 10 times in blind taste tests, and we will be in full production from farm to bottle in the land of mushrooms, Chester County, Pennsylvania, beginning in January. Nikigo.com, and we will have a range of sauces besides the original, making a whole new food segment, allergy-friendly Asian.
Perfect. Thank you so much. Susan, I'm coming to you next, and then to Simon.
Hi, Susan Hartman, co-founder of Recoup Beverage. We are a gut-healthy hydration beverage, and we're the first beverage brand to be regenerative organic certified. Right now, we are in 420 Sprouts stores. We're in Wegmans, Erewhon, Jimbo's, and we just launched in June. So kicking off really well. There's no added sugar, no stevia, very clean ingredient list, and they all have prebiotics, electrolytes, and ginger for gut healthy hydration. Thank you. All
right, Simon. And then to Carolyn after that.
Hi there, I'm Simon Solis Cohen, founder of Huxley. Huxley is a superfruit energy drink that actually offers an all-natural, healthier alternative that's redefining the energy drink category. We have 90 milligrams of plant-based caffeine, low sugar, and no artificial ingredients, and it delivers a balanced boost of energy, hydration, and focus. We're only 8 months old, and we're excited to announce we're launching in Target later this week and have incredibly high gross margins.
All right. Okay, coming to Carolyn and then to Lex. Okay. Carolyn, I think you're on mute if you're trying to unmute. Maybe we'll go. Lex, if you're ready, maybe we'll just jump to you.
Sure. Hi, everyone. I'm Lex. I'm the founder of Lexington Bakes. We make luxury brownies and cookies that are 99 to 100% organic, over 40% fair trade, have no naughty ingredients, and we feature radical ingredient transparency on the back, listing not only our ingredient list, but the exact brands, their logos that we source from, which helps us build incredible trust with consumers who have never seen our brand on shelf before. We've been top 10 at Erewhon for the last 2 years. We bring in 50% of the revenue of really, really, really powerful brands in our category, but also the protein category. And to Daniel's point earlier, we are exploring adding protein to these, not to turn it into a protein bar, but more dessert with benefits. So super indulgent, the best dessert you'll ever have, with an added bonus of protein.
Give me one. All right. I'm getting hungry here. All right. Maxie, I'm coming to you next, and then to Sarah.
Sounds good. Hi, everyone. My name is Maxie Heidenblut. I'm the founder of Happy Candy, which is a better-for-you gummy candy with 70% less sugar and no fake sugar. So no alternative sweeteners like stevia, monk fruit, allulose, no sugar alcohols like erythritol. We simply use less sugar. We only use natural flavors and colors, and all of our ingredients are non-GMO. We launched last month, and we're already in 30 locations in California, Illinois, and in New York, and talking to national retailers.
All right. Startup CPG New York community leader. Thank you. Okay. So Sarah, I'm coming to you next.
Hi, my company is Saraiz. I started this in Mexico almost 9 years ago in my kitchen, and it's growing a lot. We're now in Walmart, Costco, and other retailers in Mexico City, and we're trying to open up in the US. It's been a hustle, try to bootstrap, but we really are looking for investment because we have really good gross margins and no added oils, the best texture, and the best taste. And no sugar. Thank you.
All right. Great job. Thank you. Okay. And I'm coming to the Paioa team now.
Hi, we're Paioa. We're a Deaf and Coda family-owned business, and we focus on making frozen Asian-inspired Neapolitan pizzas, like our award-winning shelfie miso eggplant. And our mission is to create job opportunities for our deaf community. For those who have little to no training experience, provide job training as well.
All right, winners of the Shelfie Award, which you all can apply to starting in February for their miso eggplant. Don't miss it. Okay, cool. Thank you. I've got Vasisht. Sorry if I said that wrong.
No, that's right. Vasisht Ramasubramanian. That's my real name. I go by Chef V. Originally from India, I came to the States to attend the Culinary Institute of America, which I call as the Hogwarts of cooking school. And then after I graduated, worked with Jean-Georges Restaurant Group. And after opening restaurants all over the world, US, Canada, Australia, New Zealand, I started my own brand called The Flavorsmith. And currently we do condiment sauces made with all natural sweeteners like organic maple from Vermont, and local Tennessee honey, agave, and sorghum. So currently I started this business 8 months ago, and I'm ready to, the buyers of Sprouts and Walmart, they already have the products and they're going to be making decisions very soon. So I'm super excited about the prospects of this. I have 5 SKUs currently and ready to scale and take it to the next level. And I'm getting some attention from potential buyers and VCs. But I'm here. Thank you so much, Daniel, for this panel. It's so much I learned in this, so I can get ready when I'm actually in front of VCs.
All right, great job. Okay, Dina, I am coming to you next, and Carolyn, send me a note if your audio is working now.
Hi, I'm Dina. I'm with Rind, and we are also a Startup CPG Shelfie winner for our aged cheese. This is actually our paprika, but it's our aged vegan cheese. It was the first vegan cheese in the dairy section at the Whole Foods here in New York. We're in 7, going on now 8 locations. We're also found in Erewhon, and we also make Veggie Underground, which is the first and only vegan cheese made with real vegetable purees. So we are based in Brooklyn, New York here, and we are expanding nationally and trying to scale.
All right, great job. Okay, we've got Aaron.
Hey guys, this is Aaron. I'm with Grillicious. Grillicious makes it more delicious. We are transforming the way people cook in the kitchen, in their backyard, at tailgates, and of course, while camping. Grillicious are made from 100% all natural flavors. And what you do is you wipe them down on your favorite cooking surface, and now that food is infused with flavor in whatever flavors. So we have 5 flavors right now. We are selling online with Walmart, Tractor Supply, onboarding with Lowe's. We're in Gelson's in Southern California, and we're just trying to blow it up even more.
All right. Great job, Aaron. Okay, Jenna.
Hi, I'm Jenna. I'm from Silver Swallow. It's a bubbly, not boozy, non-alcoholic wine alternative. Its differentiators are that it's not made with any added sulfites or preservatives like a lot of non-alcoholic alternatives are. So it's attractive to clean eaters like myself and stores like Whole Foods Markets. But more than a product, we're rethinking drinking and helping people like parents who need more energy or menopausal women who need better sleep and more resilience to fill their flutes and feel good.
All
Cheers.
right. Awesome. Cheers. Okay, Anna, coming to you.
Change the background just in the nick of time. Hi, I'm Anna Vicino. I am the founder of Eat Happy Kitchen. I'm a best-selling low-carb cookbook author, so I've been the no sugar, no grains lady for about 12 years and yelling into the void. It's finally having its moment. These are my sauces. This is my Shelfie Award-winning puttanesca sauce. Everything is there it is. Everything's all organic Italian tomatoes, no sugar added, like I mentioned. We have a huge direct-to-consumer component. We're in about 450 retailers now. We're currently crowdfunding and doing that because I have a cookbook audience, and we're going to be growing very quickly. And Kroger's bringing us into their premium banners with about 500 stores. And so, it's an adventure every day. You guys kicked ass at pitching. Thanks for the webinar.
Okay. I think we got to our last one here, which is Elixir Kombucha.
Hey y'all, Corey Wood, co-founder of Elixir Kombucha, based in Louisville, Kentucky. I was an ICU nurse for 11 years, went down a gut health rabbit hole. In 2013, when our homebrew kombucha helped my cousin that has Crohn's disease. So yeah, we're here 2024. We're in about 400 retailers across the Midwest, about to hit capacity at our current facility, raising funds to expand in the next facility. Let's see, sales velocities at Whole Foods are 3x their category benchmark. Kroger, they're 2x their category benchmark. So we're under review for expansion right now and looking to find the right partner.
All right, investors, now let's hear what you all thought of these pitches. All right. And hey, I'm really sorry that we couldn't get to everybody. There are still a lot of hands up, but hopefully everybody will take the advice on how to follow up with them. I definitely want to make sure we get everyone out of here at the right time. So just to close out here, so I would love to then maybe just ask some of our panelists if they can give a little bit of feedback on some of the pitches that they heard here. So I'll start with you, Daniel.
Yeah, I thought the grill wipes, that was one of the most differentiated ideas I've ever seen. I feel like marinades are obviously of super high interest right now. And seasoning proteins with unique flavor is obviously something that a lot of people are looking to do. And I thought that was just a very unique form factor and way of doing that I've never seen before. So in terms of differentiation, I thought that was one of the most differentiated ideas.
All right. You know what? We might have actually lost everybody at the top of the hour, or maybe somehow I depromoted them because of just a lot of people joining, but we might have just lost them at the top of the hour. Daniel, I wonder if maybe you could just summarize for us any overall thoughts that you have on how those quick pitches are delivered, things that resonated with you, things that you feel like we're missing from some of them, how you would recommend to people.
Yeah, they're super quick. So obviously there's not a ton I can say. I would say I like when people obviously dropped the objective traction points that they've already accomplished. That's really helpful. How many stores you're in, how you're performing in those stores. I liked Lex's point on he's bringing the most dollars in the brownie set essentially in all of Erewhon. That's really interesting because it's objective and it's quantitative. I think in terms of the overall pitches for 30 seconds, I thought they were all really well done. And I think everyone did a really nice job, at least giving us a comprehensive statement on what their product is and how I would consume it. And and why they believe like it's differentiated and interesting. So I think it was very well done.
Okay, perfect. Carolyn
joined as a panelist.
Yeah, sorry
thank
about
you
that.
for promoting me. I would just add to that I really liked the pitches where I clearly knew what the product was early on and why it was different. The next piece of that is how this becomes big. Why is this a platform brand? What is the vision? I want to know that this is more than just one SKU and one product. I want to hear what your brand represents and what you're going after.
All right. Guys, what a panel. Thank you all so much. I always love hosting VCs for these panels because it's just always such an intelligent conversation where I learn so much. So thank you. And thank you to all the brands for getting up and just giving it a whirl on a quick pitch. Thank you for all of the great questions. I'm sorry we couldn't get to anyone's specific ones, but we had about 200 brands here for this one. So it can be hard to dive deep into some of the categories, but we love you all. Thank you so much again to the panelists that we had from Simple Food Ventures, from Habitat Partners, Melitas Ventures, and RCV Frontline. And hopefully we will see all of you soon at an in-person event. All right. Thank you, everyone.
Thanks,
see you on the Slack.
Bye.
All right, everybody. Thank you so much for listening to our podcast. If you loved it, I would so appreciate it if you could leave us a review. You could do it right now. If you're an Apple Podcast, you can scroll to the bottom of our Startup CPG podcast page and click on Write a Review. Leave your company name in there. I will try to read it out. If you're in Spotify, you can click on About and then the star rating icon. If you are a service provider that would like to appear on the Startup CPG podcast, you can email us at partnerships@startupcpg.com. Lastly, if you found yourself grooving along to the music, it is my band. You can visit our website and listen to more. It is superfantastics.com. Thank you, everybody. See you next time.